Good afternoon and welcome to CFA UK's Wednesday webinar at 1. My name is Gerhard Sobel. We're delighted to have Helen Thomas join us in our studios to present on the great unpriced risks and how to monitor them. In spite of busy political headlines worldwide and potential seismic shift in monetary policies by the largest central banks, the markets have remained relatively calm. Is this the new norm? You know the story of the last few years by now. Cheap money, passive inflows, low vol, all adding up to boom time for risky assets, particularly those that can be accessed for as low as a possible fee. The virtuous feedback loop has implications for those who use the price of financial assets to indicate the price of risk. The VIX index has been described as a fear index, as if its price indicated an outlook for the path of assets. The price has now been corrupted, with volatility becoming an asset class to trade in of itself. Helen Thomas is CEO of Blonde Money, an independent macroeconomic advisory firm. Helen brings together her experience in the worlds both of financial markets and politics. She was head of active currency at State Street and a partner at ABD, a global macro hedge fund. Prior to this, she worked as an advisor to George Osborne when he was Shadow Chancellor, as well as running a financial market research program at the leading think tank Policy Exchange. She also has over a decade of experience on sell-side trading floors in FX. Helen was a lead researcher for her book on financial crisis written by MPs Matthew Hancock and Nadine Zahawi, entitled Masters of Nothing: How the Crash Will Happen Again Unless We Understand Human Nature. Apologies. She's a board member of CFA UK with responsibility for value of the investment project. The presentation will take about 30 minutes, followed by Q&A. Please participate in the Q&A session using the appropriate box on your screens. That is not every day we have Helen here with us. No less from me and more from her. Helen, over to you.
Thank you very much, Gerhard, and thank you everybody for joining. So I'm here today to talk about these great unpriced risks and how to monitor them. First of all, here's a slide with a very quick overview of who we are at Blonde Money. I started this as a blog in 2013, and over the last few years, I've pulled together a team where we have experience in fund management, banking, and politics, and now we try to use that expertise to look out for icebergs ahead and navigate them for our clients. Now, what I'm going to do today is talk about the biggest icebergs out there. And let's start at the beginning with the point that the cheap money machine, the excessive liquidity in the system, it's still out there. It's still going. Gerhard mentioned in the introduction, we all know about QE. This has been going on now. This unconventional policy has been going on for the best part of a decade. It was supposed to be a one-off, and here it is, keep going. We talk often that even though we talk often about how the Federal Reserve is starting to take back, clearly, its stimulus, but there are many other central banks out there who are still engaged in the QE process. So these charts on the first slide here show that the annual change in central bank assets is still positive. There is still a wall of money out there coming from the central banks. Now, we know in the future that this is going to taper off. We'll wait to see exactly when and how. But for the moment, it's important to see that we are still in some of this unusual and unconventional phase where central banks continue to drive cheap money out into the system. And now, as a result of that cheap money, that has had an impact on the way that asset managers and investors look at how to make their investments. The wall of money from the central banks has encouraged passive investments. Now, the BIS, the Bank for International Settlements, who are the central bank of the world's central banks and who were one of the few to spot the crisis points building up in the run-up to 2007, 2008, they've just released a very interesting report on passive investments. I've put the link at the bottom of the slide, and I've taken a couple of the key charts out of that presentation because these are absolutely central to the argument I'm making today. So this chart here just shows you how significant the increase into passive money has been. It's gone from around 10% of global assets under management to almost 20% in 10 years. So it's doubled. And active management has borne the brunt, as perhaps even some people on this call may know themselves. You can understand, why people would be looking at this and saying, well, why do I bother with an active manager when a passive manager can deliver really good returns at a cheap price? And consequently, as you see in the far right-hand chart, the dark line at the top, big inflows into passive equity, and almost a mirror image on the downside there is the outflows from active funds. Now, so central banks passed the baton onto the passive money managers. The cheap money has led to even more cheap money flowing around the system. And that has led to risk-adjusted returns being phenomenal because we've had very low volatility. I say here, in 2017, the VIX index, the fear index Gerhard mentioned at the beginning, it hit a record low. Last year, there were 79 days when it traded below 10. In the entire 26-year history prior to that, it only traded below that level for 18 days. So it was really significant just how low volatility was last year. And therefore, somewhat unsurprisingly, the Sharpe ratio for the S&P 500 was in the 99th percentile for risk-adjusted returns since 1926. It really was an incredibly impressive return for the indices because of this low level of risk. Now why has risk been driven to such low levels? Why is volatility so low? Well, it started by the central banks. They deliberately mandated this. If we go back to the dark days of 2008, 2009, it was a point when nobody was taking any risk at all. And of course, that's what put the financial system and indeed the world in such a dangerous position. If nobody takes any risk, then there will never be any returns made. So what do the central banks do? Well, they had to rebalance the risk-return equation. And they did that by making the price of risk zero. They just had to do that because it had become so skewed in the other direction. But now, several years on, lots of risk is being taken, but the price of risk hasn't really caught up. That's because of these cheap money flows which keep flooding around the world. And it's a very tough environment, therefore, to be an active fund manager or indeed any kind of fund manager, because so much money chasing around the system means there's been a pressure on fees. The only way to really make profit in that system is economies of scale to get as much market share as possible. So, the way to do that is get your fees low. The big passive managers drive to become more efficient. And the chart on the bottom left there shows how everybody's expense ratios have fallen over the last few years. So now, moving on to this key question about what is the price of risk? Well, what's its real price? We have looked at historical volatility measures, and many people have that feeding into their risk management tools. But of course, it really needs to be forward-looking. And how do you get to do that? What indicator do you use to express a forward-looking component? Well, one key indicator has been the VIX index, because that is derived from options prices on the S&P 500. So options prices have an implied volatility, which of course suggests that therefore an index based on those options should incorporate future expectations of volatility. And by and large, it's certainly been the case that as the S&P 500 falls, the VIX rises. as you can see in the relationship on that chart on the right-hand side. And this has led to the VIX becoming almost an insurance product. You could buy a call on the VIX index to protect a long position in the S&P. And therefore it's been considered a way to hedge various risks. And if we look at post-financial crisis world, that nobody wants to be caught again not being aware of the risks that are out there. So what is the easiest way to protect against the tail risks, the fat tail events, the black swans that we may not know out there? Well, if this relationship out there exists and you're long of stock markets, then why not get long of the VIX as a protection against that? So that means that interest in the VIX has exploded since the financial crisis. Open interest in VIX futures has basically tripled in the past 6 years. But then, as the chart also shows, that can lead itself to the situation we're now in terms of what is the price of the VIX index actually telling us. Because once you have people engaging in this as a hedge, that it becomes a market, and then you can get imbalances. So 5th of February this year, we had a very unusual occurrence, as I'm sure everybody now knows, and it's the red dot on the chart where there was an outsized move in the VIX, much higher, even though the S&P 500, it was falling, but it wasn't falling necessarily as much as the relationship might suggest. So this is a kind of a warning sign here that we have to ask ourselves, is the VIX still fit for purpose? So there is a feedback loop that we need to look at here. We've just seen that the VIX is directly linked to the S&P 500, and it means that instead of, it used to be that stock markets may have led the price of a volatility expectation, that perhaps now expectations of volatility are themselves driving the price of stock markets. And this is the feedback loop that we now need to look at. The behavior, so we can see about this way that future volatility affects equities, but we need to look beyond that because they're starting to become a stronger feedback loop within the entire system. Let's look at financial conditions. What do you think has been happening to them as the Fed has raised interest rates? Well, are financial conditions getting tighter? And actually, they're not. They have done nothing but loosen since the Federal Reserve started hiking interest rates. Effectively, the Federal Reserve's rate rises have been cancelled out. And you can see that on this chart. This is a great slide, a great resource here from the Chicago Fed National Financial Conditions Index, which is the bottom blue line, versus the effective Fed funds rate at the top. So as the rate rises have happened, financial conditions have loosened. So why is this? Well, if we dig around into what is in this financial conditions index, there's actually 105 measures, but here are some of the biggest I've picked out for you. Straight off, one of the first things to notice is that third on that list is the VIX index. There it is again. It's one of the highest weights in there. Then you might look at some of the other indicators, and there's a lot about spreads and implied volatility. Again, this is looking at measures of risk. This is looking at tightness in the system. And the thing is that all of the things in all of the indicators in this table, they are all being impacted by the wall of money that we talked about at the beginning. They are being compressed by that wall of money. The central bank money that is then being recycled and passed into passive fund management, that is all compressing spreads, compressing volatility, and making financial conditions look a lot looser than maybe fundamentally they really are. Now, I've put into the bottom of this list, it's still a fairly high weight. It's the S&P futures market depth. We're going to return to that one. And the point here is that liquidity itself, the bid-offer spread in the market, they also reflect financial conditions. And liquidity, despite all the sloshing around in the market that we've just talked about, liquidity can easily be lost. So many of the indicators we've just seen are used for risk management purposes, but because of the market structure at the moment, The indicators may not be reflecting fundamentals, they may merely be reflecting a supply-demand imbalance within the market itself. If we recap, cheap central bank money led to more passive money, led to lower volatility, led to compressed financial conditions, which leads to more risk-taking and more money going into passive investments with their excellent risk-adjusted returns, and there's the feedback loop. And then that is affecting the price of assets themselves. Now, another point that the BIS look at in their quarterly report here is that once a stock joins the S&P 500, it becomes more correlated to the index, as you see from the chart on the bottom left-hand side. That means its price is less determined by stock-specific factors. So the behavior of the stock price is changed simply by being included in an index. Such is the power of passive money. And it's also changing company behavior. The bigger a part of the index a company becomes, the more it rides on the tide of the index. For bond indices, that means if you become an issuer with more debt, you can rise up along with that tide and get your debt issued really easily, tight spreads and nice prices. The BIS have put in a table here which confirms a statistically significant relationship between the leverage that a company takes and its weight in the bond index. Basically, why not borrow more to ride the passive money wave? Well, this means prices aren't actually telling us everything. Prices are being manipulated by the cheap money propagating throughout the system. This means that we have to be very aware of what is not priced. Just because you cannot price something doesn't mean it doesn't exist. And this is really the absolute key point about where markets find themselves right now. There are all of these indicators out there, all of them being monitored, all of them providing a kind of safety blanket for assessing the future expectations of what might happen. But the price itself is not revealing the truth about what is out there. So for a market correction to come, well, we have the Tinder, and then there comes a spark. Now, the Tinder is the passive money. You don't actually need leverage to turn the ship around. Liquidity is easily won and has been over the last decade, but it is also very easily lost. For example, exchange-traded funds, they rely on authorized participants to make markets in them. And those APs, these authorized participants, they are not obliged to always stand by and provide liquidity. This is a little bit what happened around the February 5th implosion in short volatility ETPs. And if we look, actually, even that example is really important for what it can mean in terms of if you have a reversal in some of these passive products. Look what happened to S&P futures liquidity in February. So the February blow-up was considered to be a slightly esoteric, one-off, unusual issue that happened to impact a leveraged product that not too many people were invested in. The reactions to that event have ranged from people shrugging their shoulders to people just shouting caveat emptor. People knew what they were getting into. It doesn't matter. But that would be a mistake. There is a lot we can learn from what happened that day because, yes, it was a relatively small product and the product did what it was always going to do, and it said this in its prospectus. If the VIX index goes up by more than 80% in a day, then there will be an acceleration event on the ETN and it will be cancelled, it will expire, and the investors will lose their money. But it had a huge impact in other markets. This chart on the bottom right here says, look at what happened to S&P futures liquidity in February. So although we were just talking about the VIX index and VIX futures and this being a volatility issue, the way that these products are hedged and the way that people have to manage their exposure, when something significant happens, as it did on February the 5th, you scramble wherever you can to find the liquidity you can get hold of to hedge your position. And because, as we already know, there's a strong relationship between the VIX and S&P 500. If you couldn't get access easily to the VIX market, then, or the VIX futures market, you go to the next best option, your next best correlated option. That's the S&P 500 futures, which is a huge market, massive liquidity in that market. But just look at what happened the day afterwards. The black line at the bottom is S&P 500 futures liquidity after the February 5th event. I mean, it was almost decimated. So yes, there was a small product that started this process, but it had a massive impact on a liquid market that was separate from its own. So remember how we had depth in the S&P 500 futures market in the financial conditions index. It will not take much for these indicators to start to shift. And once they start to shift, they could all start to shift. Spreads would widen. Expectations of future volatility would go up. It starts to become a feedback loop. Risk indicators then very quickly start to look very, very different to how they look right now. They start to go in the exact opposite direction. So we don't necessarily need leverage to get a fire sale. You can have it purely by money repricing what is going on. So I'm now going to talk about the spark. What could be the spark? We've got the Tinder, we've got the market structure. Well, the spark, therefore, is usually something no one's looking at, or something that isn't factored into all the models that proliferate throughout our financial system. And at the moment, there is an obsession that the price is telling us something. So the risk comes from something that's almost impossible to quantify. There may be 105 measures of risk in that financial conditions index, but what about Trump, Brexit, Macron, Germany's coalition, Catalonia, Italy's anti-establishment parties? This is happening throughout the world, the revolution against the elites, which, by the way, and we could do another seminar on this, has probably been created by the extremely easy monetary conditions that inflated asset prices and shifted equality in the system. But anyway, there's certainly a revolution going on, and that is spewing forth unexpected results. People may think right now that policymakers are impotent and perhaps that these political revolutions don't matter. But I think with the Trump trade tariffs, we're starting to learn that they're not. And in fact, the only reason that these events aren't having more of an impact yet is precisely because of the feedback loop we have got into, where we feel everything is safe and firm and solid and calm because of the prices that we see. Now, in terms of timing for this and how to monitor this going forward, there is a big political event coming up with a big deadline. And I have to use the B word, Brexit. There is so much that's still unresolved. And the fact of the matter is that muddling through is the least likely outcome. But everybody's ignoring it because, people seem to expect that it's just all going to look like how it did before. I've taken some charts here from a really good FTI consulting report on 2,500 firms in the UK, Germany, France, and Spain, where they were asked about various Brexit-related questions like, when do you expect your company to make irreversible decisions on how to prepare for Brexit? And what could it look like once we get through Brexit? And this is on this slide here. Basically, 75% of companies expect to make irreversible decisions by June of this year. That's because they expect the political picture to be very clear by June of this year. But we know already that the UK is still very divided on this issue. We know that Parliament now will have a meaningful vote on the final deal. We know a lot of the anti-Brexit campaigners out there are waiting their chance for that event to make their discontent known. So it's all very well that companies might think it all looks very clear in June, but come September, October, when the final deal all has to be done, things may look quite different, particularly when you look at public opinion, which is incredibly important when you have a minority administration, as we do in the UK at the moment. The court of public opinion tends to be what drives how the government proceeds. And here on the right-hand side, this is a survey that was actually done last summer about what would be an acceptable divorce bill. And I mean, the point here is that, even 20 billion was considered unacceptable by 2/3 of the people responding. And we know already, of course, that the divorce bill is going to be significantly higher than that. Now, of course, it's sometimes a matter of optics, and it's sometimes a matter of selling, and politics is often about selling. But we have a very divided country and a very divided government. So good luck with trying to sell that when we get there. So here is a political event that's coming up. Nothing appears to be priced for anything unusual in a market that is unable to price fundamentals particularly effectively. So that's the spark that we could see, and that's what we will be keeping our eye on very closely in the year ahead. So finally, I'd like to just summarize and say, have we all been lulled into a false sense of security by this cheap money whirlpool? We're in the final stages of a kind of euphoria. To be fair to the central banks, they had to kickstart our animal spirits. They had to rebalance that risk-return equation. But where the price of risk has now become zero, some distortive impact is being made on the price of assets. That means passive money has been taken on the baton from the central banks. They are taking on the cheap money machine, and they are whipping it into the next stage of the frenzy. By doing so, by all this extra money flooding into these risky assets, volatility measures have dropped. And then that started a feedback loop where passive money can keep on piling into risky assets because the indicators of risk are themselves determined by the price of those assets. It's become a virtuous circle. This year in February, we've started to see how quickly it can unravel. We would recommend that you keep an eye on those indicators of risk that we saw earlier on in the presentation. And importantly, how do they compare to the real risks that are out there? Because once the emperor's new clothes are revealed, the feedback loop will operate in reverse. The wall of money will come crashing down, and we can get a propagation throughout the system of a sudden realization that nobody knows what the price of risk really is because we haven't been using our judgment enough. We've been expecting the price to reveal something to us. Effectively, then, I want to leave you with the message of this, that risk management should be about judgment, not about prices in a spreadsheet. Thank you.
Thank you, Helen. Thank you for a great presentation. That leaves me with two thoughts, and maybe you'd like to comment on them. The first one is what you just said specifically about the VIX, that places huge questions on data-driven risk models, since they rely on either past volatility or the VIX itself to gauge the future.
That's absolutely right. And our entire risk management frameworks have become ever more dependent on more data because there is easier access to it and easier ability to slice and dice it through the increasing power of our computer systems. So I understand why we have gone down this route. Ironically, it's almost at exactly the worst time to do that because prices, as I say, were deliberately skewed by central banks. Now, once some of that central bank money shifts, then the price may start to reflect things, and perhaps then the risk management tools will kick in the other direction. But the worry, of course, is that it happens in an all too automated fashion. And that's what's concerning me this year.
Thank you. And as a last thought, I started thinking of that as you were talking. A bit parallel to Goodhart's law, which says when a good measure becomes a target, it ceases to be a good measure. I think what you are saying is when an indicator becomes an asset class, it no longer is a good indicator.
Absolutely.
Is that it?
That's the one.
Thank you very much, Helen.
Thank
Good
you.
afternoon to all.